Hello, everybody, and welcome to our EEP presentation today. I'm going to give it just a few more seconds here and let everybody join, and then we'll go ahead and get started. All right, everybody, let's go ahead and get started. I want to thank you guys for joining me today. Your mics are muted, so if you have any questions, the chat is open, and that's where I'll go over any of your questions. I'm not going to go over any of your questions during the presentation, but if you want to type any in, otherwise we'll just wait until the end and we'll go over everything, okay? So let's go ahead and get started. Okay, so welcome. My name is Monique Manaya. I am the sales support manager over here at Trevisa Financial. I've been in the mortgage industry since 1997, a long time. I've been in all aspects of mortgage from a broker, retail, wholesale, loan officer, processor, branch manager, but most recently, I was the EEP production manager over at this government entity. So I ran all of operations and I was pretty much there from the inception of the product. So I put a lot of the processes in place. I was also on the underwriting guideline committee. So I truly feel that being over here now at Trevisa, helping you build your EEP business, I can definitely help you with. I can help with the videos, and I truly love this program. I think it's so beneficial to so many people out there that just otherwise don't qualify for traditional financing. And so I love what I do, and I'm here to help and support you guys. We also have Norma Summers. She is your account executive. She is the same situation. She loves this program. She's had decades of knowledge with mortgage and mortgage insurance. And she has her EEP background as well that can help you guys build your business and be successful at this product. So EEP, it's the Earned Equity Program. How EEP works is we have a home buyer that just does not qualify for traditional mortgage. Whatever the situation is, they just do not fit into that box. So we have a government entity that is a Native American tribe by the name of Tule River. Because they are a government entity, they have the ability to take out as many FHA loans as they want, non-owner occupied. They do not need to income, credit, or asset qualify. So they've set up this program to where they will step in, purchase the home on behalf of your home buyer. During closing, when the Tule River signs the FHA loan docs to purchase the home, they will enter into a homeownership agreement with your home buyer, okay? The homeownership agreement or memorandum, depending on what state you're located in, gets recorded on title. So this is what really gives your home buyer the secured interest in the property. It gives them all full rights to live in the home and earn equity while they're doing so. So let's go over the players in this EEP transaction because, initially we have the home seller that is going to start out with your home buyer. They're going to, your home buyer is going to go out, pick the home that they want, put it under contract, put the earnest money down, and then this assignment addendum is going to get signed that assigns the entire contract over to Tule River, the government entity. They will then step in and have the relationship with the home seller by obtaining the FHA loan to pay them. And then they will have the relationship with the home buyer entering into the homeownership finance agreement. So one thing that I love about EEP is that they get the tax benefits. So they're going to receive a 1098 interest statement at the end of the year. They get to write off all of the interest. They have full rights to use, improve, and sell the home. They can do whatever they want to the home that makes it their own, all up to anything that requires permits. If there is something that they want to do that requires permits, they can definitely still do that. They would just need to reach out to the servicing department at Tule River after they've closed. They get to retain all equitable rights, full appreciation. So this EEP program definitely gives a lot of protection to your home buyers. A few of the EEP program highlights. So because they follow FHA, but they also have a lot of their own guidelines that are much more lenient. 3.5% down for ITIN, non-permanent resident aliens, including DACA. This program still allows for U.S. citizens. They have low and no credit scores. 3-month bank statement program. Okay, so this 3-month bank statement program is not just for self-employed, it is also for 1099 and also for W-2 employees if necessary. So for instance, we just had a borrower that was a waiter and then received a lot of cash tips. So we ended up just using the 3-month bank statement program to add up all of his income. He did get W-2 direct deposit and then all of his tip income that he deposited. So we were able to use bank statement, 3 months, just made it kind of more of a simpler, easier process. DTI, we can go up 50 over 60. And also there is no source or seasoning of funds to close. Okay, so we understand that some of the home buyers just don't have those warm and fuzzies for the banking institutions. So with that being said, they can save all their money at home and they can just deposit it a few weeks prior to closing. We also only need to verify MRI and everything else can be a letter of explanation where the funds are coming from. We do go off of FHA property types since the government entity is obtaining an FHA loan. We allow 1 to 2 units, PUDs, condos, manufactured homes. Please keep in mind that if your home buyer is out looking at a condo, it does need to be FHA approved. The government entity doesn't like to do spot approvals, okay? And then also 6% in seller contributions. I do want to make sure that you all understand and know that the seller contributions cannot go towards the home buyer's first month payment that they bring in or the government entity's fees, okay? Those can be covered by a gift. So for our self-employed home buyers, our standard expense factor is 45%, although we do have a tiered expense ratio option. Okay, so you might have a home buyer that is more service business related, and so they don't have a lot of overhead. They don't need to buy products that they're reselling. And then also maybe they don't even have any employees under them that they have to pay. So we have this tiered expense option to where we can get their expense factor all the way down to 10%. When you're pre-qualifying your home buyer, keep this option in mind. They do need to be able to obtain a CPA letter that does go over what their business type is and how many employees they have. So make sure that that is something that they can obtain. So when you're out there looking for borrowers that are going to fit for EEP, you're looking for specifically borrowers that, don't qualify for the traditional financing for their citizenship doc, ITIN, DACA. Our doc types only need 1 year of employment. And so we only need the prior year W-2, 1 month pay stub, or a written VOE. And then our alt doc is the 3-month bank statement program and also a P&L only program. Okay. So minimum credit score is 580, and that is only with one major bureau. So you're going to pull your tri-merge, and if you only get one bureau that pops up, as long as it's a 580 or higher, you're good to go. We also need one trade line that is over 12 months, 0 times 30. Okay. If they don't have the trade line that's reporting on credit, we do allow alternative trade lines. So with that being said, if you pull your home buyer's credit and there's no scores, we can do a no score program for them. And we do need to have one alternative trade line. Those can be utility bills, auto insurance, cell phone bills. I had somebody ask about a gym membership the other day, and as long as you can fully document 12-month payment history from the gym, then we can use that. So of rent needs to be 12 months. And then again, the max DTI is 50 over 60 for our assets. We only need 2 months bank statements if you're going, full doc. And gift funds are allowed. Gift funds are allowed to pay down payment and any of the entity's fees, including the first month's payment. No source or seasoning of funds to close. Few things to remember when you're looking at qualifying the property. Okay. We are going to get a full FHA appraisal. So if it is subject to, we're going to still need the 1004D. And then also the government entity has an overlay. They require a termite pest inspection in 35 states. They also require a home inspection if the property was built in 1978, or it's older than 1978. And or if your appraisal comes back and the condition is a C4 or greater. Those are the cases that a home inspection is required. If a home inspection required, we also need a warranty that includes roof coverage. Okay. The government entities underwriters are going to review your home inspections. Most of the time, they're only going to want safety required items to be repaired prior to closing. They do have cure agreements. They have 3 and 6 month cure agreements that they can add some of those repairs onto if they still want something repaired, but they don't feel like it's, quite the safety issue. And then aluminum wiring is ineligible. Also, all major systems need to be fully functional. Okay. All of the transaction, what are the funds involved? So essentially what we're going to do is we're going to take the bottom line from the final CD. Okay. So this is going to be all of the FHA closing costs and the down payment minus seller credits and minus earnest money deposit. We still have to meet MRI. And then we're going to take that amount, and the government entity is going to add that to one of their documents called an ICCD. It's their initial consumer cost disclosure with the first month payment. The first month payment is going to be Tule River's 30-year fixed payment plus their servicing fee. The servicing fee is calculated at 0.5% of the total loan amount divided by 12. And then they have their entity fees, which are $12.50 underwriting processing fee, $150 notary, 0.5% of the homeownership agreement. They charge $250 if the property is located in an HOA or a PUD. The fees are slightly different in Texas, and they will essentially take these fees plus the first month's payment plus the bottom line from the FHA CD, and those are going to be the total funds to close. All right, so this next slide is going over the actual 40-year EEP structure. The homeownership agreement is on a 40-year term, okay? So the design of the program is that there's no equity share and there's no back-end split. This is how the government entity allows your home buyer to retain all of the equity, okay? They don't charge very much up front. They have more of a pay-as-you-go model. This helps to support the tribal's goal of revenue and asset growth. They want to ensure that they continue helping home buyers out there purchase homes, but also they need to make some money to keep their process and their facilities functioning, the servicing department functioning. And so the way that the 40-year amortization works is the payment from the client is spread over the 40-year term. Okay, when they go to closing, they will have a final CCD, which is their final consumer cost disclosure, and then they will have a full amortization schedule over the 40 years. Okay, this is flexible, so they can make extra payments if they want. There's no prepayment penalty, but this allows them, again, to keep 100% appreciation of the home. The way that you mainly want to kind of think about this is that there's just a slower initial principal reduction versus the government entity's FHA loan. Okay, so it's more designed as the appreciation focused model. It balances the tribal's financial objective with home buyer wealth building. And then it's a strong alternative for buyers who are unable to qualify for FHA. So it ends up becoming a win-win. The government entity wants to ensure that the client's rights are secured. And this is why we have the homeownership agreement or the memorandum that is recorded on title. The government entity cannot come in and do anything that they want with the home because of this recorded instrument. And one of the other things is that the home buyer is entering into this partnership with the government entity and not an individual. I know that many times in the past, 20 years ago or so, people would go out and do seller financing, and some of those sellers were pocketing the payments and then walking away. This cannot happen on this program. So I wanted to go over a few of the tips and tricks for a smoother closing. We want you to be successful at EEP, so cover letters. The underwriters over there, they love to know what's going on with your file, what your story is, what the credit situations may be, income structure and assets. Are you getting a gift? Are you saving all your funds at home for now? Making sure your 1003 is fully completed. The pre-processors over there will actually throw the file back to us if an address isn't filled out on the 1003 for the employment. Letter of explanations on how income was calculated. Again, down payment, if they're getting a gift, current home disposition. If they currently already own a home that they're going to retain, the DTI then goes down to a 43/50, and they need 3 months reserves. You can reach out to myself or Norma for any scenarios that you might have. And we do have the income calculation worksheets to help calculate your income. I do have ones that the actual government entity underwriters use. So if you want to get your hands on one of those, just let me know. One of the other biggest things is setting the proper expectations here, okay? We want to make sure that we're not setting the transaction and all parties involved up for failure towards the end, where everybody gets, to the point where, why is this not closing? Why has this not closed yet? What's the delay? This is not a traditional mortgage loan. There are many moving parts. There's the two file structure. So we have our file number 1, which we also call it phase 1, that consists of your homebuyer TBD file that's getting submitted over to the government entity for pre-approval. And then we have our file number 2, which is our Tule River subject property file that gets created and started once they go under contract. Okay. So we're working on 2 file conditions. We're obtaining 2 CTCs. We have the home inspections that possibly are needed, the termites that we need to get that might need repairs. So closings. This is not a same day close and fund, guys. We have our signers that are sitting out on their reservation in Tule River in Porterville, California. The closest FedEx UPS pickup is at 4 p.m. So, and it's an hour away, not to mention. So, I used to manage them. They used to be my team. They would have to leave probably around 2:45 Pacific Standard Time to drive all the way out and drop packages off in time. So their cutoff is about 1 p.m. Pacific Standard Time to not necessarily guarantee that they'll get it signed and out same day, but that's the time that, there's a good fighting chance. If we're at month end, there could be a delay. If they get 20, 30 files same day to sign and send out, your package might be delayed. Wire transfers. Your home buyer is going to wire the full funds to close to Tule River. Tule River will retain their fees and the first month's payment, and then they will wire the bottom line to title. So they won't wire out until they've received your home buyer funds. I've seen wires delayed. Everybody has their own cutoff times. So that's something to where it can cause delays. But setting the proper expectations for the realtor partners, your buyers, we're getting people into homes. And so sometimes there's a few additional delays. But to me, I feel like it's worth it just because of the fact that, otherwise these people wouldn't be able to get into homes. And I know that everybody's trying their best, everybody's trying their hardest, but setting those expectations is truly important. A few critical components just to remember is that when you're submitting your homebuyer TBD file, we have a pre-approval checklist and it is required. At the very bottom, it has a referral name. The government entity's portal has a hard stop. So if we don't have that filled out at the bottom, we cannot continue uploading your file over to them to get submitted to underwriting. FHA county loan limits do apply. So if you submit your homebuyer TBD file, the government entity is not specifically, let's just say you submit it for a $800,000 loan amount. The government, because this is a TBD, the government entity is not going to, think that this is specifically the city and the county that this home buyer is going to find the home in. So you might get an approval for 800,000, but when they're out actually looking in specific counties, please keep in mind that the loan limits apply. So once you actually do find that home in that specific county, we may need to cut that pre-approval down. Again, I did go over the retaining an existing property. You're subject to the lower DTI and 3 months reserves. Making sure your assignment addendum is signed when you're starting phase 2. So phase 2 is our Tule River subject property file. When you upload that file and it goes to our disclosure department, they cannot and will not send docs out or initial disclosures out unless we have that assignment addendum signed by the buyer and the seller. Okay. We can get signatures from Tule River, so don't worry about that. We just want to make sure that the buyer and seller have agreed to the transfer. Lender paid versus borrower paid pricing. So when you do fill out your mortgage broker fee agreement and you select lender paid, the disclosure department is going to send out your disclosures lender paid. That cannot be changed midway. So you have to lock your loan lender paid. Vice versa for borrower. If you disclose one way, you have to lock the same way. Okay. All tiered expense ratio options need to have that CPA letter. The seller credits, the seller concessions cannot cover any of the entity fees. FHA approved condos only. Hazard insurance, the government entity, if you're going to go out and procure your own homeowner's insurance, they do have to approve it. They have about a list of 10 items that need to be specific deductibles, how everybody's, listed, and they have forms that need to be signed. We've gotten to the point to where we've been 2 to 3 weeks into this approval process, and suddenly we have found out the insurance agent will not even sign the disclosure of Tule Rivers. And so then we've ended up ordering it directly through the entity. We can order directly through the entity. Their pricing has gotten so much better over the last few years. And so I would give that a shot. It ends up being much smoother of a process. Approved title companies. So this isn't necessarily the escrow officer or the attorney that needs to be approved. It's whoever the company is that's going to provide title insurance that needs to be approved. We have a full approval list from the Tule River Title Approval Department that lists all of the companies that have agreed to their waiver of sovereign immunity. We have big companies on there: First American, Landmark, Ticor. There are 3 companies that we have struggled with over the years to get approved, that being Fidelity, Chicago, and Stewart. Termite inspection, again, 30 states, there's their overlay, and then also the property inspection. If you need a property inspection, you also need the warranty with roof coverage. So if you do a lot of ITIN, we definitely have a very competitive market for ITIN. ITIN and self-employed borrowers are probably the 2 most popular people that are utilizing EEP program. We only require the 3.5% down versus 15 to 20%, 3-month bank statements versus 12 to 24. Our DTIs of 50 over 60, and sometimes we can go over 60 with compensating factors. So if you're slightly over 60, just keep that in mind. We might need comp factors such as some additional reserves or a longer verification of rent, time on the job, things of that nature. And then where we only need a 580 minimum credit score, and only with 1 major bureau, I think that Travis is pretty competitive in the ITIN market. We have our EEP support center, so you can always call or email into the EEP questions at trevisafinancial.com. All of this comes directly to me. So I do hold a lot of trainings, and if for some reason I don't answer, maybe shoot me an email. I might get that quicker. And you can always email my personal email, which is mmanaya@trevisafinancial.com. But this option is also available to you. As I mentioned at the beginning, we truly do want to see you succeed. So we have some resources for you. Not only do we have the EEP hotline where you can reach out directly to me, but we also have these weekly trainings with the Q&A after. You can set up your own private meeting if you want to have your whole operations team come to my TPO Connect training. I go over specifically the 2-file structure and how to submit those, and also what comes next. I know that's always the biggest question is, okay, what's next? We can also do realtor trainings. So if you want to set up a training and invite a bunch of your realtor partners, we can definitely do that. We have these flyers right here where we can put your name, your company logo, and your picture on it if you want to market the EEP program. Okay, so now let's go to some Q&A. I'm going to see what we got so far in our chat. Yeah, I can definitely send you the closing cost calculating worksheet. It is located in our TPO Connect, but if you want to just put your email address down here in the chat, then I can email you over the closing cost calculation worksheet. Is the program available in all states? So we are approved in 40 plus states. And the program is available in all of those states. I would say that the biggest states that it is popular in right now is California, Arizona, Texas, Florida, Tennessee is popping up, Maryland, Virginia. So yeah. If you want to go to our website, it's trevisafinancial.com. It has all the states that we are approved in. Yes. So, okay. So this question was, can you please confirm how long the lease agreement is for? So the government entity has set the homeownership finance agreement on a 40-year term. Okay. They don't have to stay in it for 40 years. There's no prepayment penalty. The only thing that you want to consider when assisting your home buyer and exiting the property is the contract that your company may have with Trivisa in regard to rebate. Okay. Typically we say, let's, let them stay in the property for about a year. So they can assume the government entity's FHA loan when they're ready, when they've been able to get their affairs in order to qualify for FHA financing, or they can sell the home and they retain all of the appreciation. They can use that appreciation to buy another home using the EEP or not. Maybe they qualify for, conventional bigger down payment at that time. So yes, the homeownership agreement is over 40 years. Okay. Let's see if we have any other questions. Can you confirm how much of their payment goes to their equity? So again, that's going to depend on the loan amount. That's going to depend on the interest rate. But essentially, if you were to think about you can actually probably calculate this in your LOS or even throw it into Chat GPT. If you were to take the 30-year fixed, enter in the loan amount, the rate, and then say, ask ChatGPT is my best friend lately. How much is going towards this 40-year homeownership agreement versus the 30-year fixed? How much is going to be due after 3 years? Things of that nature, structuring it like that. That way you can tell, look, if my home buyer comes to me in 3 years and says, I want to sell my home, what's going to end up happening is, let's just say after 3 years, they gained 36,000 in equity. Okay. Let's just say that based on what their loan amount is and what their rate is, they are going to owe the difference of $4,000. When they sell the home, the $4,000 will come off of that $36,000 in equity, and then they'll end up walking away for 32. Or they can bring that money into the table. I just feel like it's easier if they just subtract that amount that way. Do we have any other questions? All right, perfect. Well, just know I'm going to put my email address in here really quick. Norma was not able to make it here. She had a prior engagement, but if you have any questions for her or myself, please feel free to reach out. And again, I do these trainings and then I also do private meetings and things of that nature. So if somebody's trying to call into me right now, I'm not able to answer it. Shoot me an email. I'm really good at going through emails. So let's see, we have another question. So the entity fee is spread out over the 40 years. Yes, exactly. So what the government entity wanted to do is, instead of charging a large fee up front to where it made it so some people couldn't even enter the program because they needed so many fees and amount, they needed so much money up front to enter the program, and they didn't want to take the equity. They wanted to be able to allow the home buyer to have the appreciation of the home. The spread of 40 years is what the entity created for them to be able to earn and gain money on these transactions. They need to make money. I don't know anybody in this world that you go to and say, hey, buy me a house for free. So that's their way of setting up this program. So there's not a large amount due up front, and they're not taking half of their equity. And the wonderful and beautiful thing about the way that they set that up is the shorter amount of time that they stay in this program, the less they have to pay. So obviously, the longer they stay in the program, the more they're going to need to pay when they exit the program, or they can stay in the program the entire time. Tule River doesn't have a specific amount of time that they need to exit the program. So if they had to, and if they wanted to stay in the program the whole time, great. But it's probably truly the most cost effective if they tried to exit the program maybe within 2 to 4 years, whatever they needed to do to get their affairs in order to qualify for traditional mortgage. Can a work permit buyer use this program? So essentially, if they have an ITIN or if they have a social security card, then they can utilize this program. They don't need to have an EAD card, and they can actually have an expired EAD card. The government entity just would like to see it. So if they do have one, but it's expired, go ahead and gather that from them. All right. Does anybody else have any questions? Otherwise, we can let you go for the day and give you some of your time back. Hang on, we have some typing. I talk so much, I'm losing my voice. Oh, no more questions, Kate. Wait, maybe? I wish there was a way that they would let me guys unmute you, because I would love to just have a conversation. I might look into that. I wasn't sure if you had a question. Okay, here we go. Can you point out where I can find the amount of the entity fee in the calculator? So if they refinance, they will. Can you point out where can I find the amount of the entity fee in the calculator? So if they refinance, they will have to pay it. I'm not sure if I'm quite following your question. Could I reach out to you a little bit later this afternoon and we can talk about it? Can you throw your phone number in the chat? Okay, no, I don't think anybody else can see. So I have a few more meetings, and then I can reach out to you here in a few hours if that's okay, and then we can go over that question together. Perfect. Okay, I'll give you a call back here in a few hours as soon as all of my meetings and trainings are done. All right. Okay. I know that the way that I am is I'll sometimes think of something later on. If you do, like I said, please email me, reach out to me. And if you want me to give you a call, send me your phone number in an email, and then I can set up a time that works best for both of us to give you a call. Okay? All right. Have a wonderful day, you guys. Thanks for joining. Bye-bye.